broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Sonia and Nigel. Guys, hi, good morning.
Morning.
Hi, good morning. It's all smiles, right? Before the holiday, the market is shut tomorrow. And it's that long weekend feeling, although not a long weekend, but nevertheless.
It's only Wednesday, but there's only, a day more left. 2 days, I mean, if you count today, but we already started today. So.
But we're bracing ourselves for the next good couple of weeks with regard to these truncated weeks.
Yeah.
And hopefully the...
Next week is the big one, right?
The big one,
There's a Tuesday and a Thursday.
And a Friday.
But you know what all of that is going to bring about, right? Really low volumes, hardly any participation, and comatose kind of a market, which I think we are used to for the last many days.
Yeah, I mean, actually, yesterday, Sonia and Nigel, was very lethargic. The price action was, it was comatose, as Sonia said. And I think are we starting to see the first signs of, all that manic price action from last 2 weeks starting to settle down? At least the week has kind of begun that way. So let me just quickly run you through the top things to watch out for. Starting from, of course, what we've got the handover from Wall Street. It's a quiet session in the US as well, not very much. No new headlines around the banking issues, around the financial sector. NASDAQ was down about 0.5%. The US 2-year is at about 4%. It's basically hit a little over 4% twice and then kind of retraced from there. The dollar is slightly on the back foot. The DXY index is down about 0.25% or so. So this is a very kind of okayish kind of picture. The S&P 500, by the way, is below is above the 50-day moving average. Is below the 50-day moving average, but still above the 200-day moving average. And you may be wondering, right? I mean, all what has happened with the banking crisis in the US and US markets, US big indices are still absolutely okay. And the reason for that is rotation. So tech and communications is two big areas which have outperformed the other sectors, the value sectors, hugely in 2023. As the banking crisis started to show up, these two sectors outperformed. The NASDAQ outperformed. The communication part of the US market outperformed. And as banking crisis is receding a little bit, at least we're not getting fresh headlines, you're starting to see this underperformance on the NASDAQ. Money's moving out of tech in the US, out of NASDAQ, into some of the value sectors. You're starting to see this underperformance vis-a-vis other sectors in the NASDAQ over the last few sessions or so. In any case, I mean, markets are awaiting the next clues in terms of inflation, what the Fed will do, and of course the banking situation as well. And all three are in that sense really up in the air. We don't know which way things will go. By the way, we will hear more from the FIDC, which is the depository in the US, the banking depository, and the Fed on the recent bank failures. So they, representatives from both these institutions presented before the Senate last night. There were no headlines, but they will do the same before the House, and it'll be watched keenly again for any sort of headlines which we get. Here in India, I mean, it's been painful, right? Yesterday was, at least at close with a 20-25 point cut on the Nifty, a repeat, almost an exact repeat of what we had the day before yesterday. Although yesterday was, day before yesterday, we had that big spike late in the session, which got sold off. Yesterday, we did not even have that. So 0.25% lower. Banks did better. I mean, the bank Nifty actually ended higher. On the Nifty, bulls will not give up hope as long as the 16,800, 16,850 level. We are not there yet. It's a slow grind. But if there were to be a retest and for the third time the market bounced off those levels, I think at least on the index, I mean, the view is emerging that maybe, prices have corrected quite a bit. For the broader market, it's a different story. I'll come to that in just a bit. Now, the Nifty has resistance. The levels are the same, 17,207, the 20-day moving average. There is a little bit of change. That stands now at about 17,230. These are near-term resistance levels on the upside. The Bank Nifty closed higher, as I said. It's a small higher high, higher low, as opposed, yesterday, Tuesday, as opposed to Monday. So don't read too much into it, but the margin, it's positive price action. For the Bank Nifty, crossing the 20-day moving average, which now, as of yesterday's close, stands at 40,065 and 40,201, will be important to watch out for. Sonia.
Oh, absolutely. And, now the line in the sand is that 16,800 mark, right? It hasn't been it has held so far. It's not given up yet. So I guess 16,800 to 17,500 is sort of a marker for the market, for the Nifty, that is, the range, the floor and the ceiling, so to speak. But it is a very, very range-bound market, no two ways about that. Even in the global markets, I mean, the US markets, they had mild losses, nothing much to write home about. S&P 500 was absolutely flat as well. If you look at the flows, though, in our own market, there is positive there. So the FIIs have bought in cash after 3 days of selling. FIs bought about 1,531 crores yesterday, and the domestic institutions barely sold anything. So net-net, it was positive in terms of cash market flows for our own index. So that's a good thing. There are a lot of things, right? There is the March series expiry that happens today. There's a market holiday tomorrow. So, and there's a year-end closure as well. So given all of that, there could be a little bit of volatility given that there's the March series expiry and year-end closure. But other than that, this is a defined market range that we're looking at with 16,800 on the downside. In fact, the 24th March low was 16,934, and that's something that has also been held up until now. So let's see, very, very range bound, and you know, cues are thinning out. There's no major trigger. Of course, earnings season begins in the first fortnight of April. So 13th you have Infosys numbers, but up until then, I guess auto sales is one trigger, but other than that, not much.
Well, that's right. You know, so today's expiry day, so expect volatility to pick up, particularly in the second half of trade. And the big question is, do we put an end to this gruesome series? March series hasn't been a great one at all. The Nifty is down close to around 3%. Or do we see some bit of a relief rally that plays out? That'll be on the bulls' wish list. But you know, besides the headline index, we talk about it being in the range. The broader markets have been getting pummeled, and it's long due for a good pullback. And I'll get to that in just a bit. But just telling our viewers out there that there are a lot of good quality stocks out there that have seen a big correction. Some of them valuation-wise as well have become attractive. So just keep an eye out on the broader markets. Don't lose heart, because there are a lot of good quality names in there to invest. Looking at the index first, on the index futures, the FI as well, they added shorts yet again, so they got back to their shorting ways. Short positioning moves to around 84% or thereabouts. But what's giving you some hope that maybe the recent lows will hold out is that they wrote puts. And if you're looking at the option setup, the highest open interest on the call side is at around 17,000 call, and that's 50% higher than the open interest at around that 17,000 put itself. So that's telling you the kind of bearish sentiment you get. Which brings us to the levels. Since 17,000 call has the highest open interest, the positioning is such that 17,050 does hold out. If there is some kind of good news that comes about, and if you can get past that 17,050 and trade about that, then you're bracing for a short covering bounce. Otherwise, at 17,050 will be a marker to watch on the upside. And the hope is the recent lows don't break. On the Nifty Bank, you know, last few days we have been seeing selling in the broader markets as well. But the Nifty Bank at around that 39,250 to around 39,300 odd, it's getting some bit of a support. So that becomes a support zone. While on the upside, the 200 EMA, which has not been able to cross decisively, that becomes a resistance out there. But I told you all that the broader markets could be bracing for a big relief rally, at least in the near term. And maybe in the near term, we could be forming some sort of a base in the broader markets. I'm talking about the small cap index, because a lot of participants, they could have sold some positions for tax harvesting. That's a possibility. Tax planning, this final day. So maybe we get some bit of pain more, and then maybe in fact we see a bit of a bounce. And also in select pockets, valuations have become very attractive. And just to drive home this point, the small cap index wasn't underperforming till now. Just in the last 5-6 days odd, you have the small cap index that is down a good 4.5%, while the Nifty is down marginally. I think if we can get that chart up for you on the screen, yeah, that's the one I'm talking about. The Nifty is down less than 1%, but the big pain has been the small cap indices. That's telling you there is some tax harvesting that was taking place. And that's why, you know, wherever there could be an exit, it appears there was some exit that was taken. So let's hope that we're bracing for a bit of a bounce, particularly in the broader markets. SGX Nifty is suggesting a bit of a flat start. I already gave you the range out there.
Oh, absolutely. And you know, although the headline index may look like not much is happening, right? Beneath the surface, there was so much pressure yesterday as well.
Absolutely.
I mean, not just the Adani Group stocks, but a whole host of other names in the mid and small cap stock list was down about 5-6%. The new age tech companies were under pressure. So we get fooled by the headline index being range bound, but portfolios are getting hit quite hard.
And the broader market has been in pain. You know, earlier post-COVID, everyone used to say I made 2x, 3x returns on a particular stock. Now it is the stock down 40%, or is it half, or is it more than that? You know, that's the kind of pain we've seen in the broader markets. But the point is, there are a lot of good quality stocks out there. Look at good margin business, good market share, and look at good quality businesses. There were plenty out there. You know, I did a rough check out there. So let's hope there is some bounce.
Nigel, I have some numbers. So NSE 500, right? I mean, this is the broadest gauge of stocks out there. So since the 3rd of Jan, 4th of Jan is when the NSE 500 made a high and then it started falling. So from the previous day close, 3rd of Jan, you have 116 stocks on the NSE 500 which are down more than 20%. That is almost 25% of the NSE 500 group is down more than 20%. And that, when I say more than 20%, it's 30, 40, you know. So, but 25, a quarter of the universe is down over 20%, and only 87 stocks are in the green, you know. So just
that's less than 20%.
Yeah, I mean, so it's been tough, and that is just this year so far. Just what 3 months or so, less than 3 months before we sort of end the month of March.
Thanks for starting us off on a great mood, Prashant, telling us how bad our portfolios are.
I mean, it's not, but I'll tell you what, you look at some of these stocks, right, from pre-COVID levels, if you want to really go back all the way there, I mean, stocks are still up 2x, 3x. I mean, there are very few stocks, and that may be a good exercise to do, which are back at those levels. I mean, I highlighted Sobha earlier, which is back at, but far and few in between across large sectors. Stocks are still up quite a bit from pre-COVID levels. Forget about that COVID dip, of course. That was short-lived. It was brutal, short-lived, but it was also unnatural. Well, before we go any further, let me quickly tell you what is lined up in the first half hour of the show today. We will get you updates from markets across the globe. Steve Bryce of Standard Chartered Wealth Management will be joining in to discuss the global setup. Later, our research team will bring you CNBC-TV18's list of top 10 stocks for the day. At about 8:30 this morning, we do a fundamental stock analysis with Choksi of Choksi.
Okay, so lots coming up in the next 2.5 hours, but without wasting any time, let's get talking about what to expect on the equities front first up. Well, we have a view that's coming in from Morgan Stanley, where Rhythm Desai says peaking short rates, improving terms of trade and earnings strength appears to offer a better setup for stocks. Rhythm adds that risks such as a global growth slowdown, energy prices and global liquidity, amongst others, bear watching. India's implied volatility is likely to remain relatively low.
All right, this is Mahesh Nandurkar of Jefferies, who says that the recent correction in market has made valuations more palpable at 17.2 times one-year forward earnings. 56 of the Nifty 100 stocks now trade below the 10-year historical average. Several financials, select autos and pharma, trade at a discount to averages. Mahesh adds recent improvement in current account deficit, weak commodities driving WPI softening, and recent weakening in crude augur well for the macros. They've added Ultratech Cement and Sun Pharma to the model portfolio and reduced weight on metals and Tech Mahindra.
All right, let's also get you some money market views this morning and tell you how to approach the currency today. On the rupee, Kunal Sodhani of Shinhan Bank says the dollar index remained weak and fell for the second day in a row, even as US yields rebounded. The immediate test can be the weekly low of 101.9, and a level above 103.5 will be positive for dollar bulls. Euro holds firm, helped by expectations of further rate hikes from the ECB. For the dollar INR, Kunal says 81.80 to 81.90 zone acts as a support, while 82.35 acts as an important resistance.
Well, on bonds, we have Neeraj Gambhir of Axis Bank, who says the 10-year benchmark bond yield traded in a very narrow range of between 7.29 to 7.33%. Shorter tenor bonds and T-bills witnessed selling on account of finance bill amendments, which caused debt mutual funds to lose a favorable LTCG taxation benefit. For the rest of the week, market will take cues from the government's borrowing calendar, and he expects the 10-year benchmark to trade in a range of between 7.28 to 7.35%.
Well, we have a lot of stock-specific action we're going to be tracking for you, and we'll get to that in just a bit in our special Top 10 segment. We're looking at the Adani Group, Vedanta, ICICI Lombard, ZF Stirling, RHI Magnesita, JSL Stainless, SML Isuzu, NBCC, PNB Housing. They are stocks on the back of positive news flow. While on the flip side, you have CE Infosystems. That's the only stock that could be reacting to negative news flow.
All right, Steve Bryce is now joining us, Chief Investment Officer at Standard Chartered Wealth Management. Steve, good to have you with us here. Thank you very much for your time. What are the next cues to watch out for? Because this week has started on a much better note. No fresh headlines of bank/financial sector pain. Are markets settling down?
Certainly, I seem to be getting a bit more sleep these days, which is a very pleasant development. Yeah, so things do seem to be calming down somewhat. I think if you obviously on the banking sector side, the Credit Suisse situation has calmed down in the US as well. We've seen some positive development. So From that perspective, this sort of risk of systemic crisis coming from the banking sector does seem to have diminished considerably in the past week or so. Obviously, still things can happen. I mean, we still have the situation in the commercial real estate market, particularly in the office space, that can still feed into the regional banks. But at least for now, we do seem to be getting a bit of a hiatus, which is good. I think longer term, though, we still feel that we are heading towards a recession in the US. So from that perspective, we still feel that that's something that's going to be a very significant headwind for risk assets later in the year. The question is, do we get a melt-up scenario in the short term before that happens? But ultimately, we do think we're going to make new lows for the S&P.
Okay, so you're saying we're heading towards a recession for sure in the US, and we're going to make new lows in the S&P 500. But Steve, just to play the devil's advocate here, one narrative is that a lot of the recessionary news, the layoffs, the slower growth has been priced into most global markets, and hence we haven't seen too much of an impact, especially in a market like India, which has shown a lot of resilience. Is that your view as well, that even if we do head into a full-blown recession, a lot of the damage has already been done in equity markets?
So I guess some of it has been done. Obviously, equity markets are still far from their peaks. So you can argue that some of it's priced. I think what we would say to that is you've never seen equity markets trough before a recession has started. So from that perspective, we believe that markets are not excessively cheap. They're not nothing like as expensive as they used to be, obviously, but they're not cheap. So that we can still see, at least in the global market context, we could still see some significant weakness coming through, once it becomes clear that we are in recession, and that earnings, still people are looking for a fairly placid earnings outlook in the US market, and we think that could be revised significantly lower going forward, and that will be a headwind, obviously, for stocks. Now, the question is, obviously, then at some point the Fed will pivot, and then that can lead to the growth versus value conversation, which could be positive on a relative basis for US stocks. But we still think we've yet to go through that first earnings downgrade to get to that point.
All right. Hi, Steve. Good morning. Steve, the point you made on the US equities, they could retest lows that we saw last year. So on the S&P 500, another 10 to 12% correction. Is that something that you're working with?
It could be slightly more, So I think one of the questions that we all have is, okay, I think recession is becoming increasingly a consensus call, and if anything, I think the indicators more recently are pointing to a higher probability rather than a smaller probability. So we're around a 3/4 probability that we'll see a recession in the next 12 months. But I think the question then becomes, okay, how severe will it be? Our sense is this won't just be a run-of-the-mill recession. It may be slightly worse just due to the pace of the tightening that we've seen in the US and the lagged effect of that monetary policy tightening. Obviously, what we've seen in the regional banks doesn't help either. And we believe that the Fed is going to be reluctant to pivot. So a lot of the analysis that we do on when the Fed will pivot towards cutting rates is based on history, and usually history post-1980. And the point we would make is that obviously this is a very different environment where inflation is still a challenge. So from that perspective, it might be more than neutral.
All right, Steve, what about the Indian markets? You were leaning towards the Chinese markets the last time we chatted. Indian markets, well, we've been relative underperformers just in the recent past. Now, what's the toss-up between India and China? If things are going to get a little bit jittery globally, will you go for the market that is offering earnings growth, though is relatively more expensive, or will you stick to China?
So at the moment, we're sticking to China. So from our perspective, obviously, I mean, I think the news from Alibaba, I actually read as a significant positive. I mean, one of the things that we struggle with when we look at different sectors, for instance, in China, is the predominance of, Alibaba in the consumer discretionary space. It's about 1/3 of that index, or Tencent is almost 3/4 of the communication services. So if we do see smaller entities coming through, that will deepen the market, in our opinion, and make it more investable. But obviously, the main factors for us is that we see the fundamental drivers post reopening as being very positive for the Chinese market. Valuations are much less stretched. It doesn't. Again, we've had this conversation before. It doesn't mean we're bearish on India. We do believe that India will do well, but we do prefer China at this point in time.
Okay, so you're not bearish on the Indian markets. You think India will do well, but China is your preferred market. Got that. Finally, Steve, before we let you go, is equity still a good asset class to be in for the rest of the year? Or are you changing your stance on that as well? Are you raising your allocation towards debt, towards gold, alternate asset classes? What are you looking at?
So we've been underweight equities through the first quarter. So we're retaining that view. We believe that that global recession or US recessionary market is going to be a significant headwind, particularly for developed market equities. So we retain underweight, and that's why we have a bearish call there as well. We believe that we should be in high investment grade bonds, particularly in Asia again, given the positive fundamentals. But we're pretty defensively set up, and we retain that for now.
All right. Steve, it's a pleasure as always. Thank you very much for joining in, and important points that once again markets seem to be sort of underpricing what the Fed will do, but they quickly price things back, don't they? The 2 years back at 4% after the steep sell-off that we saw amidst the banking crisis last week. Well, we'll take a quick break here. Our list of top stocks to watch with our team coming up on the other side.
Welcome back. Hope you're having a good morning. Well, as promised, let's get straight to all the top stocks that we're tracking for you. And Sonia, you're going up first up. Tell us, Adani Group, there's a clarification that's come about.
Oh, absolutely. So the Adani Group has put out a clarification on the exchanges with regards to the report that was published by the Ken yesterday. And they have strongly refuted all the allegations made in that particular report. Now, there are some important clarifications. The group says that they have completed a full prepayment of the margin-linked share-backed financing, and that aggregates to over $2 billion. So a complete repayment has been done, which is a big positive. All corresponding shares that have been pledged for those facilities have now been released. So they have released all corresponding shares as per March 12th media note. They also talk about how all share-backed facilities availed by the promoters have now been paid off, which I think could provide some relief to the stocks as well. The Listco pledged positions for Adani Green, Adani Ports, Adani Transmission and Enterprises have all reduced substantially. So the pledged shares have reduced substantially. In fact, they have given details of the pledges and how much they've reduced it. They've released 1.9 crores of Adani Enterprises promoter pledges as of March 6th. They've released 6.5 crores worth of Adani Ports pledge shares. They've released 2.8 crores of Adani Transmission promoter pledge shares as well. And Adani Green has made a disclosure as well of 2.5 crores of shares released. So a lot of this is positive news flow, and I expect the stocks to be in the green today. Some relief rally there.
Okay, all right. So that's about the Adani Group. I'm looking at Vedanta. Remember, Hindustan Zinc declared a big dividend, and the hope was that maybe, in fact, Vedanta Limited, they'll pass through all of that. And the hope was that they'll declare anything between 19 rupees to around 90 rupees 20 paise worth of dividend. They've gone ahead and they've outbeat that. So they've declared their fifth interim dividend, 20 rupees 50 paise for the year. Fiscal year, it's more than 100 rupees. The total payout from this dividend will be more than 7,600 crores odd. And out of that, remember, the promoter entity, which holds nearly around 70% stake in the company, will get bulk of it. That equates to nearly around 600 million USD. Now, that's helpful because Vedanta Resources, just a month or so ago, everyone's talking about a default. At least in the near term, they'll be able to meet their near-term obligations. So expect the stock to open up in the green, though yesterday as well, it was a relative outperformer. But let's talk about another stock, ICICI Lombard. Surabhi joins us to fill us in on details of that one. Surabhi?
ICICI Lombard is in focus today because it's held its digital day. Some key takeaways from that meet are that it is going to use tech to focus on product innovation and building unique distribution channels to increase penetration. The management did say that the tech spend has a 1.5 to 2% impact on combined ratio, but it is also driving premium growth and new partner integration. The IoT models for risk management in the SME space has increased customers by close to 1.5 times in FY23 versus what it was in FY19. The IL Take Care app has crossed 4.5 million downloads, and it has led to a 2.4 times higher hit rate in fraud detection in FY23. The app is also driving 12 times savings on its claims. The management has reiterated its guidance of achieving 102% combined ratio over the next 2 years. Brokerages have a neutral outlook on this stock. JP Morgan has a neutral rating with a target price of 1250. Morgan Stanley has an overweight rating with a target price of 1400, and Nuvama has a hold rating with a target price of 1280.
All right, Surabhi, thanks very much for that. Two more names, Mapma India and ZF Steering. Vivek has got details. Vivek, morning.
Well, two large block deals that we are tracking. Mapma India yesterday saw a significant chunk of its shareholding actually getting exchanged via the block deal. So one of the earlier investors of the company, a Japanese-based company by the name of Zenrin, actually sold 1.5% stake in the company, and at the end of the December quarter, they held almost 6.16% company. Remember, Zenrin is a Japanese-based digital mapping firm that actually aided the growth of Mapma India prior to the IPO as well. Also keep an eye out for ZF Steering, a significant block happening over there as well. So Robert Bosch Automotive, has exited its entire 25.79% stake in the company, and this was done at 400 rupees a share. Two of the already existing promoters have upped their stake. So Dinesh Munot, purchased 10.5% stake in the company, already owning 10.5% stake at the end of the December quarter. And another promoter by the name of Utkarsh Munot has further purchased 15.5% stake, having held almost 13.13% stake in the company at the end of the December quarter.
Okay, thanks a lot for that. Well, Nigel, you're watching out for JSL and RHI Magnesita.
Yeah, let's start with RHI Magnesita. I remember in February itself, they said that they're looking at raising money via equity to the tune of around 1,500 crore rupees, and the street didn't like that. Now, there's some encouraging news because at least the promoter entity will be participating in that. And out of that 1,500 crore, at least 200 crores is likely to come from them because they've scheduled a board meeting out there. So I'll view this news as possibly some part of that equity raise that we already have those details now. Next up, you're looking at JSL Stainless. Well, they've entered into a collaboration agreement with a company in Indonesia, and that's for construction and operation of a nickel pig iron smelter facility in Indonesia. The total amount they're going to be investing is around $157 million, and they'll be taking close to around 49% stake out there. The key reason that they're doing this is to assure themselves of some amount of their raw material availability, because nickel is used to produce stainless. So, the street is a little bit divided on this one, but I'm going with green because it seems the stock has already corrected a goodish bit from the recent peak. Valuation-wise as well, there is some support. So, going with green on this one.
All right. Well, let's go across to Sonal now. She has some more stocks in the news that she's watching this morning. Sonal, good morning.
Good morning, Sonia. Let me start with SML Isuzu. Effective 1st of April, after we have heard of these price hikes across the auto companies, SML Isuzu will be hiking price of trucks by 4% and buses by 6%. So that stock is in focus. NBCC has won work orders worth 146 crore rupees. We also have PNB Housing. They have approved the rights issue that they had declared earlier. So it will be a rights issue of 9 crore fully paid up equity shares, each for an amount aggregating to 2,500 crore rupees.
Okay, thanks a lot for that. So let's do a quick recap of our top stocks and focus stocks with positive news flow. Adani Group stocks after the clarification that came out on the exchanges: Vedanta, ICICI Lombard, ZF Steering, RHI Magnesita, Jindal Stainless, SML Isuzu, NBCC and PNB Housing Finance. While the only stock with negative news flow today is CE Info Systems. So let's see how that one plays out. But let's also watch out for what's happening in the world of crude. 3 days of an up move is what we're seeing there. So some recovery coming through. Manisha Gupta is joining in for a roundup of all the action there. Manisha, good morning.
Morning, Sonia. Thank you for that. Well, we are trading at a 2-week highs for the crude oil prices. We've seen 4% of gain in this week, and we are inching close to that $80 a barrel mark yet again. Well, the U.S. crude inventories may see a sharp decline by 6 million barrels is the latest trigger coming in for the crude prices. And then we have seen exports halted from Turkey. The nuclear war from Russia is adding the geopolitical premium as well. And the markets are looking at strong Chinese demand for the first quarter. That is what the final numbers are expected to show. And then not just the Brent and the WTI, but the Russian Urals also have rebounded from its 2-year lows as China and India demand continues to be quite strong. We are seeing support from the metal prices also. So whether it's aluminum or zinc, both of these metals in Asia are right now trading nearly a percentage point on the higher side. And with the rebound in many of these commodities and decline in dollar, there is support that you are seeing in rubber. That one is trading at a 2-week highs. Sugar prices trading at a 4-week highs as well. So across commodities, there is some buying opportunity seen in Asia.
All right, Manisha, thanks very much for that. Well, we'll take a very quick break here. Up next, Choksi will be joining us for some stock talk. Later, we'll also connect with Sonal Gupta of Keer Industries to discuss their business outlook going forward. Stay tuned. Both those conversations up next.
Welcome back to Bazaar Morning Call. Well, it's been a really range-bound market, and the US markets were also really quiet. So it seems like today is going to be another ho-hum sort of a day. Not too much in terms of action on the headline, but individual stocks could see movement. So let's get straight to that. Choksi of Choksi Securities is with us. Hi, good morning. First, I wanted your thoughts on how to approach the Adani Group stocks. There was a clarification that came in yesterday where the company has strongly refuted the news report published by the Ken and has spoken about how they've completed their full prepayment, of some aggregating to over $2 billion. Just wanted to understand on these stocks, Adani Enterprises, ports, green, what would you do now as a long-term investor?
Hi, Sonia. Good morning. Well, I think first and foremost, I think nothing changes fundamentally as far as I think group's business model is concerned. I believe that this year they would end with around 50,000 crore plus EBITDA. And I think it will be continuing to compound at the rate of around 20%, at least for next 3 years, as I see the business programs of the company getting unfolded. So from a perspective of looking at the business, I think the cash flow generation position remains strong and the business remains absolutely robust, I think, across all the verticals which they are operating. So fundamentals have not changed. Coming to the specific item about the pledge of shares, I believe in normal course of business also every enterprise is required to give sufficient amount of collateral comfort to the lender. And in such situation, when they default, then only I think this particular pledge of shares would come into picture. Till that point of time, I think it remains as a security. So if this understanding goes correct, I think for not only Adani Group of companies, but also for most of the other borrowers who borrow from banks, I guess I think till the time they default, the speculative elements of doubting their ability to repay, I think should not be there. So in my viewpoint, as far as the stocks are concerned and the business model of the company is concerned, nothing changes. If the correction in the price is taking place, it may be I think an opportunity, at least for some companies where I find that the fundamental remains absolutely convincing, one could possibly go for buying at during the nervous sentiment and buy in their portfolios.
Devin, hi, good morning. Any thoughts on IndusInd Bank? Was up in a down market yesterday, and I think we had a call from Bank of America saying, well, it's not a turning around story, it's turned around, and things should start to look up. Any thoughts?
Hi, Prashant. Good morning. Well, I think on one side, the bank had its own set of problems earlier period of time, which they probably completed with the cleaning off of the books wherever it was required. On the other side, the liability franchise remained absolutely convincing and strong. So that is, I think, remaining absolutely comfortable as well. The most important point, their commercial vehicle segment of lending is now showing definite signs of growth. And this is likely to continue for next 3 to 5 years. So if this bank has got a focus aligned on this particular subject of commercial lending particularly, I would think that I think they would have relatively better time going forward from the perspective of growth in the business. And given the fact that I think the stock price is remaining or available at a price at which I think the valuations are not far too expensive. In my viewpoint, I think collective sentiments in the market, or the fall in the market sentiments, whatever we call it as, I think is an opportunity to buy into some of the quality companies for a decent appreciation going forward.
Okay, all right. Devin, request you to stay with us. We're just going to get to a conversation with the management and we'll come back to you. Keer Industries, that's the first corporate that we're speaking to today. HSBC, after meeting the management, says that they're confident of mid-teen revenue growth in the medium term, along with an improvement in the EBITDA margins as well as working capital. Mr. Sonal Gupta, the CMD at Keer Industries, joins us to fill us in with some details on that front. Hi, Mr. Gupta. Good morning. Thanks so much for joining in. Well, the last time we chatted as well, you were sounding reasonably confident that mid-teens is something that you can grow with. Could you tell us, for the coming year, that's for FY24, what kind of number are you looking at growing? And margins as well were closer to around 11%. For the coming year, to what level can they improve by?
Yeah, good morning, Prashant. Sorry, Nigel. Yeah, in the financial year 24, as I indicated earlier, we expect a revenue growth of close to 15 to 17%. Although I'm always conservative in my saying, and midterm, aspect of demand and our growth is quite good because of the good infrastructure pipeline and industry growth all around. We see a good amount of growth in the cable business.
Okay, sorry, that's the cable business. I just want to understand, last time when we spoke with you, you said in the EPC business, there are some cash flow issues that you're facing. Have you resolved them now? And do you still maintain 500 crores from the EPC business?
Yes, we are going slow on EPC business, and actually this is not our core business. It was basically started some 8-9 years back to supplement our cable business. Wherever the cable demand in the particular project is good, that was the aspect, and we want to remain it near to 500 crore. We don't want to grow it much. But although the EPC pipeline is good from the distribution companies and transmission companies and other sectors.
Okay, all right. Mr. Gupta, I missed the margin number. You told us that mid-teens growth and you're being a little conservative, though demand is strong. What about margins? Could you tell us what kind of a guidance you have out there? And out of this revenue, how much of it will come in from exports? What do you end this year with? And for next year, what is your target on the exports front?
EBITDA margin, we expect to maintain between 10.5% to 11%. So far as exports are concerned, this year we expect around 11%, 10 to 11% of sales coming from exports. But next year we expect around 12.5 to 13% of sales coming from exports. So the number in exports will definitely grow because we have a very strong order book in export at the moment. And even from the domestic market, the order booking is quite strong. Similarly, in this quarter, although February was little slow, but we see a good push in our houseware sales also this month. And we expect next year it will continue.
Okay, all right. So that's 11% EBITDA margin that you're looking to maintain. Got that. And 10 to 11% of your sales will come from exports, at least in the next year. You had a new greenfield plant that was to be commissioned in the second half of FY24. Are you on track to do that? And once the plant comes on stream, what kind of revenue contribution do you see? Will it largely be for domestic? And, what would the growth look like?
See, our plan to complete the greenfield project is a bit delayed because of the land acquisition issue. So we expect that to go on stream somewhere in FY25, somewhere in the middle of that. But we are doing brownfield expansion in our Silvassa plant with a expense of around 100 crore rupees. That will bring around 15 to 20% more capacity in the FY24 for us to grow. And even in our other plants in North India, we are doing a debottlenecking, and will be able to increase the production by 10 to 15% there also.
What is your capacity utilization right now, Mr. Gupta? What are you operating at?
In cables, we are almost utilizing more than 90% now. And in houseware business, around 65%. So we have sufficient capacity to grow in houseware business, but in cables, we are doing debottlenecking and brownfield expansion in our Silvassa.
All right, Mr. Gupta, talking about market share, could you tell us for both cables and wires, how much is the unorganized market?
See, it is very difficult to predict that what is the unorganized market, but we believe around 25% is the share of the unorganized market. And I think they are catering to very small or unorganized projects or small scale industries.
Yeah.
So but some shift we will see in the coming years from unorganized to organized sector.
So you're gaining market share, right? I think last time when you joined us, you told us your market share could have gone up by close to around 100 basis points, 1%. Do you have an updated number? And for the coming year, given the kind of growth you're going to be looking at, plus the shift from unorganized to organized, what's the outlook?
it is very difficult to predict what is the shift from unorganized to organized. So far as our market share is concerned, we expect to grow by 15 to 18% in the next financial year, but I do not know how much it will be from the shift, but definitely we will be expanding our markets within domestic India as well as exports. We see a very good potential for exports when our new plants comes up, because at the moment we are feeling capacity constraints.
Okay, just one thing. Since you said that, you're expanding the business, you're putting capacity on board, exports are picking up, is there any scope to increase the dividend payout as well?
I think this year also we increased the dividend from 2 rupees 50 paisa to 3 rupees in this interim dividend which we declared in March. And definitely we'll review this suggestion of increasing the dividend payout.
All right, that'll be good. Just one last thing. Once in a while we hear from companies we speak with that the local market is showing some signs of slowdown. Are you seeing any of that?
See, I don't see a slowdown, at least in our industry, because this is more driven by capex in infrastructure sector as well as the new industries which are coming up. So, I mean, there is a bit of good investment being planned, and government infrastructure pipeline is more than 10 lakh crore in this central government budget, as well as state governments have different plans in their budgets. So we don't see a slowdown in at least the demand of cables.
All right, fair enough. Mr. Gupta, good luck. Thank you very much for joining us as always here on CNBC TV18. It is a pleasure speaking with you as always. We'll slip into a break here, but as we do that, let me quickly tell you what's lined up in the next 30 minutes or so. Anuj comes in for a quick check on the markets, what he's making of it. We'll get you the top stock picks for the day with our technical and F&O experts. We'll decode the stock rally with our on the Momentumizer segment, and before markets open, we'll also put the spotlight on the stock board, stocks you need to watch on the back of news flow, brokerage upgrades, downgrades, etc. So lots packed in right before market open. Okay, welcome back. There's 13 minutes to go for the pre-open session. SGX on your screen, absolutely flat. It's been like that now for the last 2 or 3 trading sessions now. Anuj is here in the studios to run us through what he's making of things, as always. Anuj, morning.
Morning, Prashant, Sonia, Nigel. Well, it's not as bad as it looks. It's actually worse. And, I'll just show you some data points. This is something I just analyzed this morning. And look at the number of stocks hitting 52-week highs and lows. That is a story in itself. We keep talking about the Nifty and the Bank Nifty, and we just refer to the broader market pain. But this tells you in numbers. Now, this is in A group, you have 2 stocks at 52-week high. And imagine 112 stocks at 52-week low. Forget about the advanced decline. Just look at the ratio of 52-week high to low. In B group, which is where most of the portfolios are, right? B group is the group of stocks right after A group, and the large stocks. Only 11 stocks in B group are at 52-week high, and 312 stocks are at 52-week low. Now, this is as bad a number as I have seen, and I've seen the market for the last 20 years. Others, 46 versus 292, and total 59 versus 716. Even in the worst of the phases of the market, this number doesn't cross 500 to 600, the 52-week lows. Now, that is the another sort of explainer in terms of what kind of market we are in. This is not a market which has fallen in just one way and it's fine. It's a time-consuming, painful, painstakingly slow kind of a bear phase that we are part of. I thought I'll just explain, a few seconds here and explain what's happening here. Now, this might well be presenting an opportunity to create portfolios in the broader market, but we'll find out with time and with hindsight, of course. Now, coming to today's trade, today being expiry, of course, expiry day, and we need to again be careful about the range. By the way, the Nifty has made 3 black crows, which is like 3 successive months of decline. Last time something like this had happened was way back, I think, in 2001. After that, we haven't seen that kind of move. But for last 2 days, the Nifty has respected levels. So today also, the level-based trading should work. 17,000 call and 16,900 put. Combined premium is 75 rupees. So that gives you a range of 16,825 to 17,075 for expiry. On the Bank Nifty, we had discussed 39,500 straddle yesterday. That combined premium was 500. That's come down to 350 rupees because of time decay. And the broad range is 39,150 to 39,850. But trading range is 39,325 to 39,775. And while Bank Nifty has been stronger than Nifty and has been a bit of a buy on dips kind of an index, it's struggling to cross its 200-day simple moving average, which is somewhere around 39,750, 39,800. So that becomes a bit of a near-term ceiling for Bank Nifty.
When you say three black crows, right, it sounds so menacing, like something ominous is going to happen. I mean, this is the first, I mean, you learn something new every day. This is the first time I'm hearing that.
I think the reverse of that is also there. I forgot the term, but three black crows.
Swans, crows. Swans are the more...
Actually, Sonia, this is something since you made this topic. Technical analysis is, most of the terms are derived from the Japanese market because that's the land of the rising sun. And that is where the technical analysis first took place. And all the, everything that you hear about technicals, everything is Japanese.
Anuj, I just want to make one point. The table that you put is very interesting, and if we can have that back on. I was looking at the Nifty. So basically, we've been saying, right, for the last 10 months, 15 months, this Nifty has not done very much, right? It's actually almost 19 months. In March, we will complete 19 months. So we closed August 2021 at 17,132. Yesterday, we closed at 16,960, right? Just 120-point move on the Nifty in 19 months, unless, of course, something happens. So when we talk about that 52-week range, I mean, it is kind of, it makes sense that we would, because we've been flat for so long, most of the stocks have gradually gravitated towards the lower end of that 52-week range. More than a 52-week range.
I know, see, the problem is, for people are fine if the market just falls in, one way and, it moves on. It's not that kind of a market. It's a painstakingly slow kind of a fall. It's more of a time correction that we are part of more than anything else, and that's basically how.
You know what we're hoping for? 3 white soldiers.
Three white soldiers.
That's the opposite of three black crows. Okay, all right. So you learn something new every day. Thanks, guys, for all of that. Thanks, Anuj, for joining in as well. Let's find out if there's more pain in this market in store. Mitesh Thakkar, Sudarshan Sakani are with us. Sudarshan, let me start with you. As Anuj was saying, it is a bit of a frustrating market, right? I mean, the headline is going nowhere, but your portfolios are losing value day by day. What do you do at a time like this? And for today, what should the strategy be?
Yeah, good morning, Sonia. It is frustrating. The market is not doing anything, and for many months, and it's not giving us short-term trend also. But that's we have to accept what the market gives us. And currently, the market is not giving anything at all. That's why I've been suggesting that the best trade is not to trade at all. If you can manage not to trade, you preserve your capital, and these times will go away. It is not as if the market will be like this next year, and next year. It won't be. So your capital is available for much better times to come. If you trade inside a trading range, we are in a trading range now for the short-term trader. Inside a trading range, market movement is almost random. Then you are trading inside, taking random trades. It's not worth it. So the view continues to be don't trade. If at all you still have to trade, then the trade is buy a dip, keep a stop at 16,800 and just hope.
Okay, all right. Let's welcome in Mitesh as well. Gentlemen, good morning. Mitesh, what's your sense? Another slow grinding day in store?
Morning, Prashant. It looks like that. To be very honest, I think, we've maintained that the market is ranged and choppy, but the overall bias is on the negative side, expecting eventually a break from the downside. But till that happens, I think it will be a market which will be choppy and kind of frustrating, but try to identify the ranges and trade near them. So at about 17,100, 150 is your shorting zone, around 16,850, 16,860 is your buying zone, but a break below 16,800, I think that could that could pave the way for further decline. So till that happens, I think, sell and rallies. We have some put options positions, I think, broadly maintaining a bearish outlook on the index, but future shorting may be done either near the upper end of the range or if the range starts to break on the downside. Till then, I think more of stock-specific trading is what we are up to.
Okay, all right, Mitesh, broader markets, that's going to be the focus. Individual stocks, though, give us your ideas, Mitesh.
Yeah. So, Nigel, I have a mix of buys and sell today. 2 buy and 2 sell calls. On the buying side is Glenmark, and it's done extremely well in a declining market. Currently, it can be bought with a stop at 441 for targets of 465 to about 470. And MGL, which after a good rally was sideways consolidating for the last few days, is now showing signs of restarting in a move. That's a buy with a stop at 964. Look for targets of 1010. BEL on the other side is a sell call. Keep a stop at 92. Look for targets of 85. And IDFC First Bank is a sell, but I would want to see it trade below yesterday's low. So sell on a break of 52. Keep a stop at 53.5. Look for targets of 49.
All right. And Sudarshan, how about you? What would be on your buy and sell list this morning?
See, there are still stocks which are worth buying if you are building a portfolio. This is not one of them. Alchem is a short-term trade, but it's a buying opportunity. Buy it. The trend is up. It's actually rising in this market. Keep a stop on the 31.50. It's a swing trade, but worth looking at. Ashok Leyland is an intraday short. The stock has been falling. It's in a mini bear market. Stop above 139. Finally, Manappuram is a positional buy. That stock had a big bear market. It's now recovering from that bear market. Consider it. Keep a stop at 113. And if you're a positional buyer, then the stops should be wider. You have to take more risk, but then you get more reward. But it's worth buying into. And finally, SBI Card is another intraday short. Stop above 725. The focus should be on building a portfolio rather than taking intraday trades.
All right, gentlemen, good to get those trades from both of you. Thank you very much for your time. I mean, the gold finance companies, especially Muthoot, so much damage from the highs under $1,000. I mean, a year ago would have been unimaginable, but that's where it has been at. Manappuram is recently trying to make a comeback, as Sudarshan also pointed out. We'll take a very quick break here. We'll come back with the pre-open session. We'll also have Harshvardhan Dole of IIFL to discuss the oil and gas sector, as well as the Kirit Parikh Committee report, which is the